Right guys, so let us start on with revision of accounting standard 10 property, plant and equipment. As usual, first we'll cover up the content portion of the standard and then we'll discuss certain very important practical questions in relation to AS 10. See, we will first understand the historical background. Earlier AS 10 was known as fixed asset and there was another accounting standard 6, which dealt with depreciation charge. But then subsequently accounting standard 10 was revised. It was renamed as property, plant and equipment in line with Ind AS and IFRS nomenclature, and accounting standard 6 was superseded and depreciation portion was merged into accounting standard 10. So as of today we don't have accounting standard 6 and accounting standard 10 has been renamed as property, plant and equipment. But in substance, property, plant and equipment would largely mean our tangible fixed assets. By tangible fixed assets we know that it's land, building, plant, machinery, vehicles, computer systems, office equipments and etc. Right? So now we'll start on this standard. Will give us guidance in relation to three aspects. First, recognition of the asset, that is initial recognition of our PP or that to say our fixed assets. Then it will talk about carrying amount of the fixed asset, that is at what value will you carry this fixed asset at each balance sheet date after initial recognition. And then it will also provide us guidance in relation to computation and accounting for the depreciation charge. First, let us understand the definition of PPE. PPE has been defined as tangible item that are held for use in the production or supply of goods and services. It is held for rental to others and for administrative purpose. So let us look at this. The main purpose of holding a PPE is that we will use that PPE directly in our production of goods or in rendering of service or in supply of goods or services. You may also hold PPE for the purpose of giving them on rentals. For example, I have a fleet of car and I rent this fleet of car to people, right, and I earn rental income out of it. They will be classified under the definition of PPE. And for administrative purpose, that means that in a business, right, there would be some assets like plant and machinery which are directly deployed in manufacture of goods, but there would be other assets as well, maybe assets in our accounting office, in our marketing office, etc. These assets are also contributing towards the business in an administrative aspect, and these will also be considered under the definition of property, plant and equipment. Even assets which are held for safety reasons would also be considered under the definition of PPE under accounting standard 10. And the second aspect of the definition says that these tangible items, these PPE are expected to be used for a period of more than 12 months from the date of acquisition, right? So you are using it for a period of more than 12 months. Then we'll talk about the recognition aspect of it, that when will you record the PPE in the books of accounts, right? The PPE has to be recorded at cost, right? So it says that the cost of an item of PPE is to be recognized as an asset if and only if these two conditions are met. The first condition is that it is probable that the future economic benefits associated with that item will flow to the enterprise, and the second thing is that the cost of the item can be measured reliably. So it says that the expenditure which you are incurring in PPE, you are expecting that the enterprise will get benefit out of that expenditure in future, and the cost of the item of PPE can be measured reliably. Normally there is no problem in let's say identifying the cost of an item of PP. And when we talk about the cost of an item of PP, right, there are two levels at which the costs are incurred. One, when you are making the PP or when you are acquiring the PP, that means the cost incurred till the time you make the initial recognition or first time you record that PP in the books of accounts. And then there are certain costs which will be incurred after your PP has been capitalized in the books of accounts. That will be known as subsequent cost. Like, we need to understand how to deal with this subsequent cost. Some subsequent costs are of the nature which are for the maintenance of the asset and have to be charged on to the statement of profit and loss. Some subsequent costs which will be incurred on PP, right, may be such that it may lead to future economic benefits and they will have to be capitalized with the cost of the or the carrying value of the asset. So it says subsequent costs relating to day-to-day servicing, which is normally known as repair and maintenance, have to be charged to the statement of profit and loss. Then there might be certain items of PPE which requires replacement at regular intervals. I'll give you an example. Let's say in an airline, right, an aeroplane normally constitutes of three major components. One is the body of the airplane, which is known as the airframe, right? Then there is the engine of the airplane, and then there is the interior, the seating arrangement, etc., which is that these are the three major components, right? The outer frame and the engine have a longer useful life, but the interior of the airplane, which is the seats, aisles, etc., right, would require replacement after regular intervals because of excessive usage, right? So in that case, if you are replacing it, right, that replacement will be capitalized to the cost of the item of PP. So it is replacement at regular interval. Cost of replacement is recognized in the carrying amount of the PP. That means you will capitalize that cost. If that cost meets the recognition criteria, means by that replacement you will get future economic benefits, and that cost can be identified reliably. Then we talk about major inspection. There are certain type of assets which will require major inspection at certain regular intervals. The standard says that this major inspection should be treated as a replacement, and the cost of this major inspection should be capitalized to the item of the fixed asset if it meets the recognition criteria. So subsequent costs, we have talked about three items: day-to-day servicing costs. These are in the nature of repair and maintenance. These have to be charged to the statement of profit and loss. Replacement are to be capitalized to the value of the asset if they meet the recognition criteria. Major inspection have to be treated just like a replacement, and they have to be capitalized with the carrying amount of the PP if they meet the recognition criteria. And then the carrying amount of the earlier part or the earlier inspection have to be de-recognized when you are recognizing the new mal. I'll give you an example. Let's say in an airplane, we estimated that the useful life of the interior, which is the seats, etc., is 8 years, and we are depreciating that seats, etc., over a useful life of 8 years. But after 6 years, we realized that now the seats have been worn out and we need to put in new seats, and let's throw out or dispose of the earlier one. So when we'll have the new seats in place, we'll capitalize the cost of these new seats to the cost of the airplane. But till this date, right, we have depreciated till 4 years, and 2 years of cost is still lying in the block of that particular aeroplane. We need to take it off. We need to de-recognize the carrying amount relating to the seats for the residual period of 2 years, right? When we are capitalizing the new seating or cost of the new seating arrangement. Then we'll talk about measurement of PPC. This measurement has to be done twice. One at the time of initial recognition, that is the first time you are capitalizing your item of PP, and second is after recognition, that is you are carrying on the PP at each balance sheet date. The initial recognition has to be done at cost, and the cost will have three components: the purchase cost, the directly attributable cost, and initial estimate of dismantling, removing and restoring the site, that we will talk about. And after initial recognition, right, you have capitalized the asset in the books of accounts. Then at each balance sheet date, you have an option either to follow the cost model or you can follow the revaluation model. First, we'll talk about the initial recognition at cost, and we'll look at the three components, which is purchase cost, directly attributable cost, and initial estimate of dismantling, removing and restoring the site. First, we'll talk about the purchase cost. Purchase cost is basically the purchase price of the asset, less any trade discount which we get from the vendor, add any non-refundable duties and taxes. Please remember that GST is a refundable duty. We get an input credit of GST. So GST will not be included in the cost of the fixed asset. Right? This is what we get as the purchase cost. Then directly attributable expenses means all those expenses which are necessary in bringing the asset to its location and condition, and bringing it to such a condition that now it is in a position as intended by the management for the use of the assets. So directly attributable cost means any cost directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by the management. As the management was intending to use the asset, right, now that particular asset is in that position. Till that time, whatever directly attributable costs or necessary costs are incurred has to be considered as the cost of the item of PP. Then we'll take an example of directly attributable cost. These are employee benefit expenses, means salary expenses, etc., labor charges, etc., in relation to the PP. Cost of preparation of the site, maybe there's some machinery which needs to be put on a platform, etc. You need to prepare the site and then that can be installed. Initial delivery and handling charges, this is basically your transportation cost, insurance cost, loading, unloading cost in relation to the item of PP. installation and assembly cost, professional fee in relation to PP, cost of trial run. See, what is trial run? That once you, let's say, install a plant and machinery, just to check whether that plant and machinery is operating in the manner intended or not, you do a trial run, right? So the cost of trial run has to be capitalized to the cost of the asset, but there will be some production which will be generated out of this trial run. Once that production is sold off, whatever revenue you generate, that will not be treated as sales, but that will be deducted from the cost of your trial run. So that is less sales value of item produced in the trial run. So please remember, trial run cost is to be capitalized to the cost of the item of PP. Any revenue generated from selling the produce of the trial run has to be reduced from the cost of the trial run. And then initial estimate of dismantling, removing the item and restoring the site on which the asset is located. I'll give you a simple example. With the help of it, you will be able to understand. Let's say we take a new classroom facility, and in that new classroom facility we are installing 15 window ACs, right? So to install those 15 window ACs, we need to cut the wall at 15 places and install those ACs, right? When I informed that to the landlord, he told me that you are installing 15 window ACs, you are cutting various places on the wall. Once you leave the premises, once your lease period is over, you need to again put the bricks at the places where you have taken the bricks out and install the window AC. So let's say my lease period is 9 years. Once after the period of 9 years, I will remove these AC when I will vacate the place, right? So after removing the AC, I have to again put the bricks and get the wall in proper condition. This is the cost which I will incur after a period of 9 years. But this cost is being incurred by virtue of using this premises for a period of 9 years. So I have to estimate what cost I will incur in repairing the walls when I leave the premises after the period of 9 years, and recognize that cost to the cost of the PP at its present value. That we know there is a time value of money. For example, I will incur 1 lakh rupees at the end of 9 years to repair the wall. I have to discount it using a certain discount rate and recognize the present value of that to the cost of the item of PP. This is known as initial estimate of dismantling, removing the item and restoring the site. This normally comes into play in case of mining sites as well, right? When we get license from the government for mining at certain mines, right, we install our plant and machinery at that place. The government usually says that once your license is over, you need to restore that site, remove your machinery, etc. from that particular site. So that cost will be estimated and it will be discounted to its present value and it will be capitalized to the cost of the item of PPE. Then we'll talk about example of costs that are not the cost of item of PP. So you need to remember these items, that if this item comes into picture, you cannot consider them as cost of the item of PP. First, inauguration cost. So when you are opening a new facility, right, there's an inauguration which you do. You cannot consider it as cost of your PPE. Then cost of advertising and promotion. When you are, let's say, launching a new product, you incur certain costs in advertising and promotion. That is not to be included in the cost of the item of the PPE. Then your staff training cost. So when you are conducting your business at a newer location or maybe you are expanding, right, the cost which you are incurring, right, in training your staff, etc. in relation to this cannot be considered as the cost of the PPE. And those administrative and general overheads which do not have anything to do to bring the asset PPE to its present location and condition are not to be considered as the cost of the item of PPE. Capitalization of carrying amount of PPE ceases, right? So at what point you will stop capitalizing the cost incurred in relation to the PPE to the cost of the PPE and charge them off to the statement of profit and loss, right? It says that when the property, plant and equipment is at the location as in the condition that it can be used as intended by the management, that is the point you will stop capitalizing the cost to the item of the PPE. For example, if I buy an AC, right, the cost of the AC will be there, then the transportation charge from the vendor to my premises will be there, then the installation charge at the requisite place will be included in the cost of the AC. But any cost incurred after that, now the AC is in a position that it can be used as it was intended by me. Afterwards, if I am incurring any cost, it will not be considered for capitalizing in the cost of the PPE. Cost incurred in using or redeploying the item are not incurred, right, included in the carrying amount. So once the plant and machinery is installed, right, you have to have people to operate that machinery, etc. Those costs will not be considered in the cost of the item of PPE. Then there are certain other example of cost which will not be included in the carrying amount of the PPE. The first item says that your asset is ready for the intended use. Right? Now it is in a position that it can be used in the manner intended by the management, but you don't use that asset, or maybe you are using that asset at a lower capacity. During that period, if certain costs are incurred, right, that will not be capitalized in the cost of the item of PP. Cost incurred while an item capable of being operating as intended by the management has yet to be brought into use or is operating as less than full capacity, you will not capitalize the cost in relation to this particular time. Initial operating losses normally happen that in the initial period, right, there are certain losses which are incurred. These are not considered as cost of the item of PP. If you are relocating your, let's say, processes and you need to, let's say, relocate your machinery, etc., these will not be treated as the cost of the item of PP. Cost of relocating or reorganizing part or all of the operations of the enterprise. Then there might be certain cost which is getting incurred, or there are certain incomes which are getting generated, but these expenses and income have nothing to do with bringing the item of PP to its present location and condition and making it capable of being used by as intended by the management. These expenses and these income will not be considered as part of the cost of the item of PP. I'll give you an example. Maybe we buy a plot of land for the purpose of constructing our factory premises on that plot of land. So we have purchased this plot of land, but our construction of factory premises, the factory building, etc., will start after a period of 6 months. So during that period of 6 months, I created parking space in that land and I let out that parking space to various people who needed to park their car. So there will be certain cost which will be incurred and there will be revenue generated out of, let's say, letting out the parking space. These two activities are not necessary in any ways to bringing my factory premises in place or building or constructing factory building on that land. So this cost and this income will not be considered as part of the cost of the PP, and this have to be taken to the statement of profit and loss. Then cost of self-constructed asset, right? You need to determine the cost using the same principle as the cost you determine for an acquired asset. If there is similar asset which is made for sale, means let's say I am into construction of buildings and now I am constructing my own office building, right? The same principles which I use, or maybe I can give you another example would be better. Let's say I am into manufacturing of laptops and I want to, let's say, take certain laptops for my office use as well, right? So the laptop which I am manufacturing for sale will be considered as my inventory, but the laptop which I want to use for my business purpose will be considered as my PP. How will I consider or how will I calculate the cost of that item of laptop? Right? It will be same based on the principles of accounting standard 2. How you calculate your cost of inventory, same way you will calculate the cost of PPE. And we know that we don't consider any internal profits in the cost of inventory, and any abnormal wastage of material, labor and overheads is also not considered as part of the cost of the inventory. So in case we are manufacturing the same item for sale and same item we are using for our business, the cost will be determined as per the principles of accounting standard 2. Then we'll talk about measurement of cost, right? How do you identify the cost of an item of PP? It says that cost is the cash price equivalent. Let us understand the concept of cash price equivalent. Let's say I am buying a laptop and I say that I will make the payment upfront. I'll pay the entire cost of the laptop upfront, right? They quote me a price of 50,000 rupees. If I tell them that I want to pay the cost of laptops in 12 installments, right? Then will they give it to me for 50,000? No, there will be time value of money involved, certain interest implications will come, and they tell me that if I pay it in 12 installment, I have to pay 52,000. So in the first case, when I am paying cash upfront, the cost becomes 50. In the second case, when I am saying that I will pay the cost of the laptop in 12 installments, right, my cost becomes 52,000, right? But this 52,000 is not the cash price equivalent. The cash price is 50,000. 2,000 is the amount of interest, right? So it says when you are talking about the cost of an item of PP, always consider the cash price equivalent as the price of the PP. When the interest element is included therein, you will not consider that interest element as the cost of the item of PPE. So if I am making a payment of 52,000 total to the vendor, right, and the cash price equivalent is 50,000, right, 2,000 will be considered as interest expense which will be charged to the statement of profit and loss, or if it's a qualifying asset, it will be dealt with as per accounting standard 16, but the cost of the PPE will be considered the cash price equivalent. Then there might be scenario wherein I am acquiring an item of fixed asset but I am not making payment in cash, right? I am making a payment by giving up some other non-monetary asset, or partly it's like I am giving cash and partly I am giving some other non-monetary asset. In that case, how will we identify the cost of the item of PPE? It says that the cost should be identified at the fair value of asset acquired, right? It should be on the basis of fair value of the asset acquired. Maybe for example, let's say I am buying a new laptop, and in exchange I am giving the vendor, let's say, 3 old laptops, right? So there's a non-monetary asset coming in and a non-monetary asset going out. What will be the cost of the new laptop? It will be the fair value of the new laptop which I am acquired, but that will not be considered if the exchange transaction lacks commercial substance, or fair value of neither the asset received or the asset given can be measured reliably. So there are two options. I am taking a non-monetary asset, and in exchange I am making the payment by giving up another non-monetary asset. The first criteria says that look at the fair value of the PPE which you are acquiring and capitalize that in the books of accounts. Alternatively, if the fair value of the asset which you are giving is more clearly evident, then you should capitalize at fair value of the asset given up. If neither is the case, then you should consider the cost as the carrying amount of the asset given up, right? So whatever assets you are giving up to acquire a new asset, you should look at the carrying amount in your books of accounts of the asset which you are giving up, and that should be considered as the cost of the new PPE that you have acquired. Another situation could be, right, this usually happens when a bucket of assets are purchased at a particular price. Let's say we are buying, let's say, plant machinery, land and building, office equipments, vehicles, etc., right, at a total consideration of 100 crore, right? We are paying lump sum consideration of 100 crore and we are acquiring so many assets, right? How will we attribute this 100 crore to plant and machinery, land and building, office equipment and vehicles? The standard says that look at the fair value of each of these assets and apportion this 100 crore in the ratio of fair value, right? You have to allocate this 100 crore on the basis of fair value of the assets which you have acquired, right? Consideration is to be apportioned to the various item on the basis of respective fair value on the date of acquisition. But if the fair value cannot be determined reliably, then the value are to be estimated on fair basis by a competent valuer. If the fair value cannot be determined, right, on a reasonable basis, then you need to deploy a competent valuer, and based on the valuation done by the competent valuer, you need to determine the value of the various assets which you have acquired by paying a lump sum consideration. Now we'll talk about measurement after recognition, right? Initial recognition we all know has to be done at cost. After the initial recognition, at each balance sheet date, right, we need to carry our fixed asset, right? There is an option, either you can follow the cost model or you can follow the revaluation model. If you choose the cost model, then you have capitalized it at cost, right? You will charge the depreciation, you will charge impairment loss, and then you will get the carrying amount of the item of PP, right? You may also follow a revaluation model. It says after initial recognition, an item of PP whose fair value can be measured reliably should be carried at revalued amount. How do you calculate the revalued amount? Right, it is the fair value of the asset on the date of revaluation, right? So at each balance sheet date, you have to look at the fair value, right? And that fair value should be considered as the carrying amount of the asset. So fair value of the asset on the date of revaluation less any subsequent accumulated depreciation and any subsequent accumulated impairment loss. So you will arrive at the fair value. From that fair value, based on the useful life of the asset, you will calculate the depreciation charge, and based on impairment analysis, you will charge impairment as well, and you will arrive at the carrying value of the amount of PP. Please remember that accounting standard 10 prohibits selective revaluation. It says that whenever you are following revaluation model, entire class of that particular asset should be revalued. So when I say entire class of that asset should be revalued, means let's say we have land and building, that is one class of asset. We have plant and machinery. We have computers, right? That's one class of this thing. We have vehicles, that one class of PP. We have, let's say, office equipment, that one class of PP, right? So you cannot do selective revaluation. That means that if you are following revaluation model for your land and building, right, all the land and building with the enterprise has to be under the revaluation model. For example, let's say you have 7 buildings, right? You want to do 3 at revaluation and you want to do 4 at cost model is not possible. If you are choosing revaluation model, all the assets under that particular class has to be under revaluation model. Another example, if we are choosing revaluation model for plant and machinery, all the plant and machinery of the enterprise should be based on revaluation model. There cannot be a mixture of revaluation or cost model within a particular class of asset. Then determination of fair value. How, when you are following the revaluation model, you have to let's say carry your PPE at fair value. How will you calculate that fair value? How will you get that fair value? Determined on the basis of market evidence, right, by professionally qualified valuer. So you need to go to a valuer. That valuer will be professionally qualified to determine the fair value of your various items of asset. If market based evidence are not available, means your asset is unique, right? There is no active market for that particular asset. In that case, there are other methods like income approach or depreciated replacement cost approach, which could be used for the purpose of calculating the fair value of the asset. What is the frequency at which you should do revaluation? See, whenever you following revaluation model, you need to keep in mind that your asset should reflect the fair value of the asset at each balance sheet date. So what you need to see is whether there is any significant fluctuation in the fair value of your asset or the fair value of the asset is relatively stable. If there is a significant fluctuation in the fair value of your asset, you need to do an annual revaluation. At each balance sheet date, you need to carry out a revaluation activity by deploying a certain competent valuer, and you need to determine the revalued amount of the asset. But if the fair value of your asset is relatively stable, it does not significantly fluctuate, in that case you have an option to do revaluation in an interval of 3 to 5 years. Then we'll talk about accounting treatment of revaluation. See, whenever there is a revaluation, the revaluation can be upward, the value of the asset could increase, the revaluation could be downward, that means the value of the asset could decrease. How do you do the accounting for this change in the value of the fixed asset? So when an item of PP is revalued, the carrying amount is adjusted to the revalued amount. So you need to bring the carrying amount of your PPE to the revalued amount. There are 2 methods in which you can do this adjustments in your books of accounts, right? I have taken 2 examples, right? I'll call it as method 1 and method 2. Look at these examples very carefully. We say that before revaluation, cost of the item of PPE was ₹1,000. The accumulated depreciation till date is 400, and the net book value of this item of PP is 600. Now this item has to be revalued at 1500. Right? So item which has a carrying amount of 600, the fair value of this item is 1500. You need to take it at 1500. There are 2 ways in which you can do an adjustment. First of all, the net book value is 600 and the revalued amount is 1500. So therefore there is a gain, right? There is a revaluation gain to the extent of 900 which you need to recognize. How will you do the accounting for this? See, before your revaluation, the cost is 1000, accumulated depreciation is 400, and your net book value is 600. In the first method, what you will do, listen to this very carefully. In the first method, you will add the revalued amount to the cost, right? You will add the revalued amount to the cost. So now 1000 was the cost, 1500 is the revalued amount, right? PP after revaluation will become 2500, but your net book value has to be 1500, right? So if I want to make this 2500 1500, right, I need to deduct 1000 amount of accumulated depreciation. Right now in the books of accounts we have 400. I want to make this 400 1000, so I'll charge additional depreciation. I will increase my accumulated depreciation to reach 1000 by crediting the accumulated depreciation account by 600. So see what treatment are we doing? We need to take the revalued amount to 1500. So I am saying PPE account debit, which is the cost component, right? We have increased it by 1500. We'll say to accumulated depreciation. Accumulated depreciation has a credit balance. If we need to increase our accumulated depreciation, we need to credit it, right? And to revaluation surplus 900, right? So this 1000 plus 1500 became 2500, 400 plus 600 became 1000, 2500 minus 1000 became 1500. Now this net book value of 600 has become 1500, and thereby we have recognized a revaluation gain of 900. This is the first method in which the adjustment has to be done. The second method, we are taking the same example, but the treatment will be little different. The cost before revaluation is 1000 and depreciation is 400. The net book value is 600, right? After revaluation, right, I will make the cost as 1500. I will not adjust the accumulated depreciation, and this will be the final book value. So what I need to do, I need to increase the cost of the PPE by 500. That's it. No other adjustment will be required. Right, and thereby there will be a revaluation gain of 900. Right, so here what I need to do is, I need to, the entry which I will pass is PPE account will be debited by 900 to revaluation reserve 900. See, I had 1000 in the cost column of PPE. Add 900 of revaluation gain, this becomes 1900. We have 400 of accumulated depreciation, so the net book value becomes at revalued amount of 1500. Right? So whatever is the revaluation gain, you will have to add it to the cost of the asset, or what is the revaluation loss, you have to directly deduct it from the cost of the asset. Then we'll talk about increase and decrease in revaluation. See, when we revalue the asset, the revaluation can be an upward revaluation, the revaluation can be a downward revaluation. If it's an upward revaluation, there's a gain, but this gain we cannot take it to the PL because this is an unrealized gain, right? It is just by changing the value of the asset to its fair value. So if there is a gain on revaluation, it should be taken to an account known as revaluation surplus, which is in the nature of capital reserve, and it will appear under the reserve and surplus head in the balance sheet. But if there is a decrease, if there is a loss, then you have to debit it to the statement of profit and loss. So initially when there is a revaluation gain, you will credit it to the revaluation surplus. Initially when there is a revaluation loss, right, initially means for the first time when you are doing this revaluation activity, it will be taken to the statement of profit and loss. But at various subsequent dates also, you will look at the fair value of the asset, and there could be a gain or there could be a loss. So when you are doing the subsequent adjustment, you need to keep in mind that what was the initial adjustment did you do. We'll take an example, and with the help of that example we'll understand about this adjustment. Let's say there was a machinery which has a value of 5 lakh. There's an upward revaluation and it is upward revalued at 6 lakhs. So the value of plant and machinery is increasing by 1 lakh. So for this we pass an entry, plant and machinery account debit to revaluation surplus 1 lakh. So 5 lakh was in the block. Now we have debited by 1 lakh. It has become 6 lakh, and 1 lakh of revaluation surplus has been recognized. So this is the first time when we are doing the revaluation activity. Then there's a subsequent downward revaluation, right? There's a subsequent downward revaluation. In there two cases which you have taken, case A and case B. Subsequently, there's a downward revaluation to 5,70,000. So see, my plant and machinery currently is appearing at 6 lakh, and now I want to bring it at 5,70,000. So there's a loss to the extent of 30,000, right? I need to reduce the value of plant and machinery by 30,000. So I will say plant and machinery account credit, and this loss of 30,000 will be debited to the revaluation reserve account, because we already have a credit balance of 1 lakh in this account. To the extent of this 1 lakh, we will always debit the revaluation reserve account. But in the another case, we are saying that the downward revaluation is 4,80,000. So in the books, the plant and machinery is appearing at 6 lakh, and we need to bring it down to 4,80,000. In this case, there is a revaluation loss of 1,20,000. In this case, please note the entry, very important. We will debit revaluation surplus by 1 lakh. Why by 1 lakh? Because there is a maximum balance of 1 lakh which is available in this account. right? To the extent of excess, we will have to debit the profit and loss account, and the value of plant and machinery will decrease by 1,20,000. Are you absolutely clear? So when you are initially increasing the value, you will credit it to the revaluation surplus. Subsequently, if there is a downward revaluation, to the extent there is a balance in revaluation surplus, debit the revaluation surplus. But if the reduction in the value of the asset is more than the balance in revaluation surplus, the excess will be debited to the statement of profit and loss. And in the same analogy, let's say the plant and machinery is at 5 lakh, we do an initial downward revaluation of 420, right? So there's a loss of 80,000. This loss will directly go to the statement of profit and loss. Our entry will be profit and loss account, debit 80,000 to plant and machinery 80,000. Subsequently, right, after doing this downward revaluation, we have upward revaluation. Again, we have taken two cases, case A and case B. In the first case, we are taking it to 450. So 450 minus 420. In this case, there is a gain of 30,000. So we'll debit the plant and machinery by 30,000 and we'll credit the statement of profit and loss by 30,000 because we have recorded a loss of loss to the extent of 80,000 in relation to this asset. In the second case, right, we are taking this plant and machinery to 550. Currently, it is appearing in the books as 420. Right, here there is a gain of 130. Right, in this case, look at the treatment very carefully. To the extent of see, we need to increase the value of plant and machinery by 130. So we'll debit the plant and machinery account by 130. Right. To the extent of loss I had earlier recognized, I will credit my profit and loss account. Over and above whatever is the gain, that gain will go to my revaluation surplus account. So if there is an initial downward revaluation, debit your PL. Subsequently, if there is an upward revaluation, right, first you need to credit your profit and loss to the extent of the loss you had debited earlier, and over and above that loss, if there is a gain, you will take it to the revaluation reserve account. Please go through these two examples very carefully. Then we'll talk about bearer plan. See, this is a new inclusion in the accounting standard 12 revised scenario, which is PP. Let us understand what do we mean by a bearer plant. Bearer plant would essentially mean a plant, right? The purpose of let's say having that plant in place is to get fruits or the output out of that plant. I can give you an example, right? The best example could be, let's say, a mango tree, right? A mango tree is basically there for the purpose of cultivation of mangoes, right? Our intention is not to sell that mango tree. Our intention of having a mango tree is to get the fruit mango which is there and selling that fruit, right? So a bearer plant is such a plant which is held for the purpose of bearing some vegetable or fruit, right? I can give you another example. Let's say sugar cane. Sugar cane is also a plant, but that sugar cane, entire cane is extracted from the soil and sold off in the market. It cannot be treated as a bearer plant. So what is a bearer plant? Bearer plant is a plant that is used in production or supply of agricultural produce. So that is a plant which bears either fruits or vegetable. That is not a plant which is sold off as such in the market. It is expected to bear produce for more than period of 12 months. So it's not that the plant will bear and it will be finished off within a period of 12 months. That's a plant which will be used for a long period of time. And there's a very remote likelihood of being sold off as agricultural produce except for incidental scraps. Maybe this mango tree grows very old and now it has stopped bearing. So maybe I'll cut off this mango tree, I'll sell off the woods and I'll plant a new mango tree. That's incidental because of usage over a period of time. My intention was never that I will plant a mango tree and then I will sell that mango tree off, right? So following are the examples of items which are not bearer plant. Plant cultivated to be harvested, right? So for example, sugarcane. It's a plant which is cultivated so that it can be harvested and the sugarcane can be sold in the market. Plant cultivated to produce agricultural produce. When there is more than remote likelihood that the entity will also harvest and sell the plant, right? So there are certain cases where there is a produce from that plant, and that plant is also extracted and sold off in the market, or annual crop like rice, maize, etc., right? These are also not to be treated as bearer plant. So bearer plant is essentially a plant. The objective of owning that particular plant is that that plant will bear certain fruits or vegetables, etc., and that fruits or vegetables will be sold off in the market, but that particular plant will not be sold off, except for the fact when that useful life of that plant comes to an end, that plant may be sold off like a scrap. Accounting for bearer plant, it has to be done as you do accounting for a self-acquired or self-constructed item of PP. So essentially what will happen, I plant let's say there's a farm in which I plant mango trees, right? I will capitalize the cost till the time these mango trees start bearing fruit. Once these mango trees start bearing fruit, right, the cost which is incurred in maintaining these that particular farm will be charged to the statement of profit and loss. Then we'll talk about depreciation. We all know that depreciation is an expense that is charged off to the statement of profit and loss. Understand the concept. The expenditure which I am incurring after acquisition of a PP is normally known as a capital expenditure, right? Why do we call it as capital expenditure? Because it is an expenditure, but the benefit of this expenditure I will get over a long period of time. So let's say if I am buying a particular mobile phone, right, for rupees 1 lakh, and I intend to use that mobile phone for a period of 5 years, then 1 lakh divided by 5, 20,000 is the expense which I will charge off every year, right, as a depreciation, as allocating the cost of the asset as an expense, right? So depreciation is what? Depreciation is a systematic allocation of the depreciable amount of an asset over its useful life, right? So why do we call it as depreciable amount? I'll give you an example. Let's say I buy a phone for 1 lakh rupees and I will use it for 5 years. I said that I will depreciate 20,000 each year. I'll modify this example a little bit. Let's say I buy this particular plant. Right, I'll modify this example a little bit. Let's say I buy this particular plant. I buy this particular phone for 1 lakh rupees. I believe that I will use it for 5 years, and after 5 years I will sell it off, let's say for 10,000, right? So my effective cost becomes 90,000, right? 1 lakh I have incurred, 10,000 I will get. 90,000 is what is my cost which I need to allocate over the period of 5 years. So this 90,000 is nothing but the depreciable amount. So depreciable amount is basically the cost minus the residual value, which is the depreciable amount which you need to apportion over its useful life. What is the residual value? Residual value is basically the amount which you expect to realize, right, once you dispose of that asset at the end of its useful life. What is useful life? Useful life is considered in two ways, in terms of period, number of years for which you could use the asset. There could be certain assets, right, which you cannot calculate the useful life in terms of period, right? The useful life of that asset could be the quantity that asset could produce, or number of hours for the asset could be used, right? So it will be number of production or other similar units for which the asset can be used, right? Residue value and useful life both are an estimate, right? I might buy a phone and I say I use it for 5 years. If that phone performs well, I may use it for 7 years. If it does not work well, I may sell that phone off after 2 years as well. Again, the residual value, I say that after 5 years I will realize 10,000 rupees. Maybe I will realize 12,000 rupees. Maybe I realize 5,000 rupees. So both these items are an estimate, right? So residual value and useful life and item of PP should be reviewed at each financial year end, and if the expectation differs from the previous estimate, previously I thought I'll use it for 5 years, or maybe I'll get 10,000 rupees, at each balance sheet date I have to review whether my initial estimate was correct or not, and if there is a change in my estimate, I need to change that estimate, and that change will be treated as change in accounting estimate as per accounting standard 5, right? Then commencement of depreciation. When will you start depreciating your asset? Simple, when the asset is ready for the use, right? Means when the asset is in the location and condition and in a position where it is capable of being used as intended by the management. Whether you use that asset or not, that does not matter. For example, let's say I buy an AC and I install that AC, but after installing it is ready for use. But if I don't use that AC at all for 2 years, will I not charge depreciation on it? The answer is I have to charge depreciation, right? it should be ready for use. Whether I am using it or not, it does not matter. So depreciation is also charged on ideal asset as well. Depreciation on an asset begins when it is available for use, right? That is when it is in the location and condition necessary for it, for capable of operating in the manner in which the management intends to use that asset. Depreciation ceases, right? When will you stop charging depreciation on an asset, right? When will you stop charging depreciation on an asset? Depreciation of an asset ceases as earlier of date the asset is retired from active use. So now we are not actively using that asset anymore. And very important, held for disposal. So you are not using the asset, it has been retired from active use, and also now it is your intention to sell this asset off, you want to dispose this asset off. The date the asset is derecognized. Derecognized means when you record something in the books of accounts, that is known as recognition. When you pass an entry in the books of accounts, it is known as recognition. Derecognized means when you take off that asset from your books of accounts, that is known as derecognition. Therefore, depreciation does not cease when asset becomes idle. So if you are not using the asset, that does not mean you will not charge depreciation. Or is retired from active use but not held for sale. You are not using that asset actively, but you also don't intend to dispose that asset off, right? If that is the fact, you still have to charge depreciation on that asset. Both the conditions should be met, that the asset is retired from active use, and also it is your intention that you are wanting to dispose of that asset as well. Now, depreciation method, right? It is the duty of the management to choose a proper method of charging depreciation on its PP, right? What should be the methodology of selecting this method? It says that your method of depreciation should reflect the consumption pattern of your asset, right? The manner in which you will get benefit from that asset, right? In that same particular pattern, you should charge depreciation on that particular asset. The depreciation method should reflect the pattern in which future economic benefits of the asset are expected to be consumed by the management. So what are the available methods? There's straight line method, there's diminishing balance method, and unit of production method, something like you would have studied at your foundation level, which is let's say production unit method or machine hour method or maybe depletion method, etc. Depreciation method, which is based on revenue generated by that asset, is not considered as appropriate, right? You should not charge depreciation based on your expectation of generation of revenue from that particular asset. Now, very important segment, component method of depreciation. Here we'll talk about two things. One, segregating the component, another is grouping the component. I had taken an example that an aeroplane will have three important components: airframe, engine, and the interiors, right? This cumulatively would form a significant portion of the cost of the airplane. The useful life of the airframe will be, let's say the external body is 20 years, the engine is, let's say, 15 years, and the interiors is 5 years, right? So maybe an airplane costs 600 crore rupees. What you need to do is you need to allocate this 600 rupees between the airframe, between the engine, and the interiors, and depreciate each of these components based on their respective useful life. That is known as segregating the component. You have airplane as a single unit, right? The cost of that single unit is 600 crore, but the significant component of the airplane have significantly different useful life. The external body has a useful life, for example, of 20 years, the engine has a useful life of 15 years, and the interiors 5 years. So you cannot depreciate entire 6 crore on the basis of either 20, 15 or 5. You need to allocate the cost between the three significant major components, and you need to depreciate each significant major component based on its respective useful life. Then grouping of component, I'll take an example. Let's say there is a plant and machinery. Plant and machinery has 4 parts, part A, B, C and D. Part A has a useful life of, let's say, 20 years. Part B also has a useful life of 20 years. Part C has a useful life of, let's say, 12 years, and part D has a useful life of, let's say, 8 years, right? So in this case, component A and B should be grouped together, and depreciation on component A and B should be charged together, and C and D should be depreciated separately based on their respective useful life, right? So first situation you were segregating, right? You were segregating different components and charging depreciation as per their respective useful life. In the second case, you see that there are certain significant components which have similar useful life or same useful life. For those components where there is a same or a similar useful life, you will club them together and charge depreciation on them together, and for those components which have a different useful life, you will charge as per their respective useful life. Review of the method. See, again, this method of depreciation depends upon the consumption pattern, your expectation of future economic benefits from the asset. If your consumption pattern of the asset changes, if your expectation of future economic benefit or the pattern of future economic benefits from that particular asset changes, you should also change your method of depreciation to reflect the current consumption pattern of that asset, and this change should be treated as change in accounting estimate and should be dealt with as per accounting standard 5. Then, see, there could be certain scenarios in which the cost of the asset or the value of the asset changes. Why does it change? Right, we had seen that you have to put in the estimated value of dismantling, removing and restoration of site. That estimate may change. There might be certain price adjustment with your vendor. There could be certain duties which would be levied on that asset, right? So there are several circumstances in which the value of your asset could change. How would you deal with that change? That change should either be added or reduced from the cost of your asset, but your asset could be carried at two different ways, right? You could choose a cost model or you could choose a revaluation model as well. So if you are choosing cost model, then any change in the liability should be added or deducted, means adjusted with the cost of the asset. But if you are choosing revaluation model, in that case it is absolutely pertinent that your asset is appearing at its fair value in the balance sheet, right? So you do not do an adjustment with the value of the asset, rather that adjustment in the value of the liability, right, it alters either your revaluation surplus or it alters your PL balance when that adjustment is done. So important thing which you need to remember, when there is a change in the value of the asset because of various reasons, you need to first see which model are you following. If you are following the cost model, it's pretty simple, that if there is an increase in liability, you will add that amount to the value or the carrying amount of your asset. If there is a decrease in the liability, you will reduce the carrying amount of your asset. But if you are following revaluation model, you cannot do any change in relation to change in the liability of the asset with the value of your PP. Any adjustment which originates from the change in the value of the liability has to be necessarily done either with your revaluation surplus or with your statement of profit and loss. So it says that if there is a decrease in liability, it should be credited to revaluation surplus. If there is an increase in the liability, it should be debited to the statement of profit and loss. Higher, but in the previous occasion, there was a downward revaluation and it was debited to the PL, then to that extent you credit to the PL, and if you need to credit more, you will choose revaluation surplus. Same way, if there was revaluation surplus in the earlier extent, first you will debit the revaluation surplus. Any debit more than the balance in the revaluation surplus will be debited to the statement of profit and loss. Then retirement of an item of PP means now the item is not in active use, you want to dispose of that item of PP. The item of PP retired from active use and held for disposal should be stated. So earlier it was under your non-current asset. Please listen to this very carefully. Your PP is under non-current asset. When your non-current asset is held for sale, it comes under current assets and it is under other current assets category in your schedule 3 balance sheet, right? So this reclassification from non-current asset to current asset as fixed asset held for sale should be done at lower of the carrying amount, means the value at which that asset is appearing in your balance sheet, or the net realizable value of that. It's on the basis of conservatism, because now you don't want to use this item of PP. This PP is held for sale. So same way you value your inventory cost or NRV, whichever is lower, right? You use that same principle. You will see the carrying amount of that item of PP in your books of account. You will see the net realizable value. Whichever is the lower value, at that value you will reclassify from non-current asset PP to other current asset as non-current asset held for sale. Any write down in this regard is obviously recognized in the statement of profit and loss. Derecognition means you take off that asset from your books of accounts. The derecognition should be done either on disposal, you are selling off that asset, or maybe there are no future economic benefit from the expected use or disposal. You need to scrap that off, you need to throw that asset off. In this case, right, you derecognize the value from the books of accounts. Gain or loss is net disposal proceeds minus carrying amount, right? Whenever you're derecognizing also, any gain or loss will go to the statement of profit and loss. Another important point, we said that the definition of PP is asset held for use, then for rentals to others. So if you're holding an item of PP and you're giving it to rentals to other people, right? And after a certain number of years, that particular asset you are selling off, right? Maybe I have a fleet of car and I'm renting that fleet of car and earning rental income, right? Couple of cars in that fleet have become old and now I want to dispose of these cars. So I'm not using it for rentals. Now it is held for sale, right? So when it is held for sale, we have seen whenever an item of PP is held for sale, right, it will be treated as non-current asset held for sale under other current assets in the current asset category in our balance sheet. But if you are using an item of PP for rentals to others and then now you want to dispose of this item, it will not go under no other current assets, right? It will be treated as your inventory, right? Should be transferred to inventory at their carrying amount, and the sales proceeds should be treated as revenue as per accounting standard 9. Please note this difference. And then disclosures, you need to state your measurement basis, whether you are doing the cost model or you are doing the revaluation model. There could be some class of asset which you will follow cost model. There could be some class of asset where you are following revaluation model. What method of depreciation you are using, what are your useful life or depreciation rate. You need to state your gross carrying amount and accumulated depreciation at the beginning and at the end of the year, and you need to do a reconciliation as what was the opening balance, what is the addition, what is the disposal, and what is the closing balance. This reconciliation needs to be shown for the cost element and for the accumulated depreciation element of the asset as well. So by this we are done with the revision of accounting standard 10. We'll move on to certain very important practical questions in relation to them, right? Let's read question number 1. It says Omega Limited contracted with a supplier to purchase machinery which is to be installed in one of its departments in 3 months' time. Special foundation were required for the machine which were to be prepared within its supply lead time, means which is to be constructed within 3 months. The cost of the site and laying the foundation is 140. So this 140 is the cost because it is necessary to install the machinery. These activities were supervised by a technician during the entire period of 3 months, who is employed for this purpose at 45,000 per month. So 45,000 into 3 months is the lead time. So 1,35,000 is incurred as salary to this technician. The machinery is purchased at 1,58,000. So this is basically a purchase price. And transportation cost, this will also be considered as cost of inventory directly, cost of PP directly attributable. In bringing the machinery to factory, an architect was appointed at a fee of 30. This is also considered as cost to supervise the machinery installation, right? You are required to ascertain the amount at which the machinery should be capitalized. So based on this, we have seen that all the items are such that which should be included in the cost of the inventory. So we say purchase price, cost of site preparation, technician salary, initial delivery cost, professional fee, and this becomes the cost of our item of PPE. Next question, question number 2. It says Hema Limited purchased a machinery on 1/4/2008 for 15 lakhs. So this is the cost. The company charged straight line method of depreciation on 15-year useful working life and residue value of 3 lakhs. So basically 15 lakh minus 3 lakh, 12 lakh divided by 15 is the amount of depreciation per year. At the beginning of the 4th year, means after charging depreciation till the 3rd year, the company, by way of systematic evaluation, revalued the machinery upward by 20% of the net book value. So whatever is the net book value at the end of the 3rd year, 20% of that was treated as upward revaluation and was added to the cost of the machinery and brought it to its revalued amount. and also re-estimated the useful life as 7 years. So now they have re-estimated that the useful life is not 15 years, but as of date it is 7 years, and the scrap value is nil. Earlier we considered that 3 lakh, now the scrap value is nil. The increase in net book value was credited directly to the revaluation reserve, obviously because this 3 lakh of 20% increase revaluation will go to the revaluation purpose. Depreciation on straight line basis later on was charged to statement of profit and loss. At the beginning of the 8th year, the company decided to dispose of the machinery and estimated the realizable value to be 2 lakh. You are required to ascertain the amount to be charged to profit and loss account at the beginning of the 8th year with reference to AS 10. So they are saying that at the beginning of the 8th year or in the 8th year when you are disposing of this item of PPE, right, what should be your amount that should be taken to your statement of profit and loss. Please listen to this very carefully. In this sum, initially it has been said that the useful life of the machine is 15 years. The machine has been used for, let's say, 3 years, and in the 4th year you do a revaluation activity, right, and you revalue the machinery upward by 20%, and you also re-estimate the useful life of the machine as 7 years. See, now there could be two aspects. First, we could assume that after 3rd year, the remaining useful life is 7 years, right? So till 3 years you have used it, you will use it for another 7 years, and effectively total useful life becomes 10 years. There could be another assumption as well, as that the total life of the asset is 7 years. You have already used it for 3 years. 7 minus 3, now the remaining useful life is 4 years. Right? So it's not clear from the question as to whether they are saying that the total useful life has become 7 years or the remaining useful life of this machine after using it till 3 years is 7 years. So we'll look at it from both the perspective. First, we will assume that the remaining life is 7 years, right? We have used till 3 years, and in the 4th year, we see that the remaining useful life of this machine is 7 years. It can be used for another 7 years. So, cost of the machinery initial 15 lakh. We have charged depreciation for first 3 years, which is 15 lakh minus 3 lakh residual value divided by 15 into 3. This is the net book value of the machinery at the end of the 3rd year, or we may call it as at the beginning of the 4th year. 20% revaluation increase, so 12 lakh 60,000 into 20%, this is the revaluation increase. This is the revalued amount of the machinery at the beginning of the 4th year. Now, from the 4th year, this machinery can be used for another 7 years. So we will say 15 lakh 12,000 divided by 7 into 4. Why into 4? Because in the 8th year I am disposing of this machinery. So I will charge depreciation for the 4th year, 5th year, 6th year and 7th year. So this 4 would mean 4th year, 5th year, 6th year and 7th year, right? For 4 years I am charging of the depreciation, which is 864, and WDV of the machine at the beginning of the 8th year becomes so much. When we'll sell off, we'll get 2 lakh rupees, and 4 lakh 48 lakh is considered as loss on sale. See, there is a upward revaluation of 252 and there's a loss of 248. So, 448. So, out of 448, to the extent of revaluation surplus, we will debit our revaluation surplus, and balance, which is 448 minus 252 of revaluation surplus, 196 will be taken to statement of profit and loss as a loss, right? Then, if we assume that the total useful life of the machinery is 7 years, 3 years we have used, right? The total life is 7 years, so now it can be used for remaining 4 years only, which is the 4th year, 5th year, 6th year, 7th year, and in the 8th year we are disposing of that machinery. In that case, we will say revalued amount at the beginning of the 4th year that we have already calculated here, so same amount we will directly use, right? This is the revaluation amount at the beginning of the 4th year. Now depreciation for 4th to 7th year is basically 15 lakh 12,000 divided by 4 into 4, because 4 years is the remaining useful life and we are using it for 4 years. The entire things become depreciated. WDV becomes 0. 2 lakh rupees is the sales proceed, and this 2 lakh becomes profit on sale. Clear? Then question number 3, it says Versatile Limited purchased a machinery for 4,80,000 inclusive of GST of 40,000. See, this GST cannot be considered as cost because GST will get the input credit. The input credit is available for GST paid, so effectively it is 4,40,000 is our cost. The company incurred the following other expenses for installation. Cost of preparation of site for installation is so much. See, here again in this sum we need to identify what will be the total cost. So this will be included in the cost. Total labor charges is 66,000. It says 200 out of 600 man hours worked were spent on the installation of this machinery. So here this 66,000 is cost of entire 600 hours. We need to allocate for 200 hours. Spare part consumed will be taken. Total salary of supervisor is so much. Time spent is 25% of total time. So out of this only 25% will be attributable to this particular asset. Administrative expenses so much. 1/10 relate to plant installation. So 1/10 of this will be treated as our cost. Test run and experimental production, we have seen that test run cost will be considered as the cost of the item of PPE. Consultation charges to architect for plant setup will be considered. Depreciation on asset used for installation. So there are certain assets which we have used in installing this particular item of PPE, right? So depreciation of this asset should be taken as cost of the item of this PPE. The machinery was ready for used on 1/15/115. But was used on 1st February 15. So it was ready on 15th of January, but we did not use it. We used it from 1st of February. Due to this delay, expense of 19,000 were incurred, right? Calculate the value of the plant to be capitalized. So we have seen that when the asset is ready to be used as intended by the management, but if it is not used or it is used below capacity, the cost incurred for that should not be considered as part of the cost of the PPE. So this 19,000 should not be considered as the cost of the PPE, right? So let us look at the computation. Purchase price net of GST 440. Site preparation 2166 divided by 600 into 200. Spare parts allocable supervisor salary 24,000 into 25%. Allocable administrative expense 32,000 ka 110. Test run and experimental production expenses, consultation charges and depreciation of asset installed for use. This will become our cost of PP, and we'll say as per accounting standard 10, cost incurred while an item is capable of operating in the manner intended by the management has yet to be brought into use or is not included in the carrying amount of PP, and therefore 1900 will not be included in the cost. So by this we are done with the revision of accounting standard 10. Please like the video if you have understood and if you like the particular revision, right? Also you can comment your feedback on this particular revision, and do subscribe to our channel so that you get notification for our other revision videos and other contents as well. Thank you so much and all the best for your exam.